Well, today we're reviewing two funds from 361. In May of this year, we reviewed the 361 Flexible Opportunity Fund, and in August, we reviewed the 361 Target Return Fund, and that's subsequently been renamed to 361 Met Equity Fund as of the 1st of August. Joining us now to discuss some of these changes, Evan Walker from 361 Asset Management, co-fund manager for 361 Equity Fund. Evan, thank you so much for joining us today. Firstly, let's just get a macro view or an overall view of your investment philosophy at 361 and the kind of investment process you have right now.
Okay, so fundamentally 361 is a bottom-up investment house. We look specifically at stocks and we look specifically at sectors. And we spend a lot of time understanding industries and what industries will survive or do well in the current or forthcoming macro environment.
Okay.
So we don't profess to be macro experts at all, but we do look at shares that we think we can do better or worse in the environment that we're currently presented with or the environment we foresee over the next 12, 24 months.
So let's take a view of the clips that we had from the 361 Target Return Fund, and as I said, that has been subsequently renamed and reclassified as an equity fund. But let's just take a glance back at some of the comments that were made in a past show about that. I mean, what is this fund doing to be able to charge such high costs?
Well, I think the first thing to take into consideration here is that a large portion of the total expense ratio in this situation actually comes from a performance-based fee. So it's not a flat fee that we're looking at it from a performance-based perspective. I mean, I fully agree. I think the fee is obviously on the high side here. I don't know what Roland, what do you think about the fees?
Well, again, the fees are benchmarked according to the repo rate. So we're actually saying if we outperform repo, we deserve a performance-based fee. If you look at the structure of the fund with about 75% in equities and 25% in cash, sort of on average, that should be the benchmark because that's what they're on average holding, rather than a repo
this
rate.
This benchmark question keeps coming into the whole debate, you know.
Correct.
Yeah.
Well, as a matter of fact, let's just briefly look at returns quickly. 1 year, 23.6% relative to the repo rate of 5.5. 3 years annualized, 27.2 versus 6. 5 years annualized, 11.7 versus 7.9. So I mean, those are fantastic returns relative to that benchmark. But the question again is around fairness. How fair is this repo rate kind of benchmark?
Well, the best way to probably judge this fund is, it's not the best way, but a better way is to compare them to similar equity funds. So at least you've got a peer group kind of comparison, because the repo rate really isn't relevant here. So if we haven't obviously got that, but it would be interesting to see how this fund would compare to other funds with 75% on average in equity or the general equity fund.
A 3-year annualized return, 27%. That's good. That's good.
That's right. Our market has probably doubled over the last couple of years, so you can see where those returns are coming from.
Well, there were questions being raised there around cost, questions being raised around the benchmark, which at that time was the repo rate, but it has subsequently been changed. So Evan, of course, let's get your response to those comments that were raised.
Okay, firstly, I don't think what's properly understood is a performance fee is based on the performance. So if you look at the 361 funds currently over a 3-year period, we're by far the leading funds in the South African market. We've compounded, as you said, 28% over the last 3 years. And the 2-unit trusts currently are 10% ahead of the next best competitor. That's after charging the fee. So I think what's important for viewers to understand is the performance is after the fee. The fee is already included in the performance. I don't think it comes across strongly enough in the previous clips. Okay, secondly, if you just look at the history of this business, and if you look at the compound returns, we've always outperformed the ALSI over every single duration from inception.
So the question, I suppose, that you had on the table, Roland, was given the high weighting in equities, why was the benchmark of a repo rate being used?
Well, generally the sort of global guidelines when it comes to choosing a benchmark is to have something that is highly correlated to what the fund is doing. Because if your benchmark isn't correlated to the strategy, then it's not that relevant, is the term that is often used in terms of the quality of the benchmark. So I have no discussion about the fact that they haven't outperformed the market, but the correlation of repo to an equity fund or a high equity allocation is very low because you have a risk-free benchmark and a volatile portfolio. So those things are not like for like, and therefore making comparisons about skill is not necessarily relevant. So it's probably a better idea to have the same volatility in your benchmark that you're having in your fund. And certainly if we did that, we would see that the returns would have generated, the fund would have generated a higher return than those risks.
Yeah.
But that's sort of the
And hence that was the reason why the fund was reclassified, and that's hence why the benchmark was changed.
So moved into an equity space now, full equity.
Because initially it was a target return fund,
Yeah.
and initially it had a high weighting of cash and bonds in the fund, and that was slowly transformed, and we felt it wasn't an appropriate benchmark for the fund. And obviously, with myself coming on board, previously I was a small cap manager at Momentum Asset Management for 5 years. With myself coming on board, we thought it was an ideal time to change the benchmark of the fund and reposition it going forward.
You see, I mean, it's an interesting debate because, I mean, Samantha, you'll attest to this. We have a benchmarking debate almost every single week on the fund where we ask the question, are funds appropriately benchmarked against the correct type of benchmarks for what they're actually trying to achieve? Now, I mean, one can understand it. 5 years ago, 36ONE starts a fund within a flexible asset allocation type environment, and they say, well, we want to make sure this thing's flexible, and from a return perspective, let's make sure this thing stays ahead of cash or repo, so to speak. And hence, over time, as this thing builds and it becomes more of an equity fund, obviously it attracts higher and higher and higher fees because, quite frankly, repo is not really correlated to what they're trying to do in the fund, hence the reclassification. One thing that I do see happening more and more in the industry is where funds are trying to get market-related benchmarks, but because they want to behave in an absolute space, so they want to try and create a return in an absolute space, they have a target as well. And hence, like for instance, the Flexible Opportunity Fund, even that you guys run, has got a repo plus 2% benchmark.
Yes.
Has that got if that could be the target, is there an appropriate benchmark for something like that as well?
It's a similar dynamic for us. It was also a fund that was created with a large cash reserve. I mean, it's also a benchmark that we're currently looking at investigating. And yes, but I think what you have to understand is, although there's a performance fee built into this, the performance has been so high in these funds that it's actually distorted the TER. So your total expense ratio looks high, but there's not a single fund in the South African market that's come close to these funds over the last 3 years, which has been exceptional.
Okay.
So again, if you look at us benchmarking ourselves relative to all the other funds in the market and what all the other funds charge, whether they're repo position plus 2 or they're Swix positions, it's actually irrelevant. The TER has made no difference to the performance at all. So we don't sit and basically apologize for the good returns. In fact, we want people to be able to look at returns like this, say, why are you doing so well, and obviously bring their money and invest with us. I think.
So for someone out there who's looking at TERs of 3.12%, because obviously, you look at the absolute numbers of various funds against each other. You've got the Flexible Opportunity Fund with a TER of 4.94%, almost 5%.
Yes.
Break that down in terms of to what extent that number is reflective of performance. If you had to strip out performance,
Yes.
what are the underlying costs and we're paying for the asset management?
Well, you're paying the normal management fee like any other company would. So you're paying the same as you would if you went to Allen Gray, Investec, Coronation, any of the big houses, and they all have performance fees. The difference is that we've delivered on those performance fees, and obviously the TER is incorporated, but you haven't paid that. So what's important here is you haven't paid that. You've had 28% compound growth in your money for the last 3 years, and you've had 18% compound growth in your money since inception, and that's after the cost. So what a lot of people do is they sit there and they say, we're paying 3% for our money, but it's not being properly invested. So the difference is that in a lot of cases, where the management fee is 1.5, these funds are actually underperforming. So what I don't see on this program is I don't see people saying, why aren't you going out there, why aren't you challenging the asset managers because they're only delivering below their benchmark and you're still getting charged a management fee accordingly. So we don't apologize for charging, we're actually very, very pleased that we've charged because people have had this exceptional return.
Okay, Roland, do you agree, basically?
Well, I would say that there are two drivers of the TER, and we mustn't forget that it's not just performance. It is also the benchmark. In fact, the biggest driver of your TER is the choice of benchmark. So we have to distinguish those two aspects. The performance-based fee is based once that hurdle rate is reached. So if the hurdle rate is set at repo plus 2, it's very different to a Swix kind of hurdle rate. So the TER is actually very largely affected by choice of benchmark, not just performance.
You've come on board, you've identified that, and changes have been made.
Yes, exactly.
Yeah.
I mean, I think there's, if you look in the industry, there's two divergent opinions. I mean, if you speak to the fund management industry would often say, look, we're trying to create returns, and if I create the returns, there should be a commensurable fee for that return. And I mean, we can debate on what a commensurable fee is for return at the end of the day. The other side of the equation is the advisory community, which would probably sit down and say, what is it I'm paying for what I'm getting? Because all returns are cyclical in nature. that outperforms now might not outperform in 2 years' time or 3 or 4 years' time? And am I giving my clients enough traction when this strategy falls out of favor so that I can, quite frankly, make sure that they've got money so they can invest at the bottom end of the cycle? Is that taken into consideration over here? And hence those two divergent opinions is kind of the space that the institutional management arena kind of plays in, which kind of makes it an interesting debate. And I mean, we've asked that question on previous shows. What is a fair price to pay, for advice and for asset management, you know?
We have had many discussions around that, Evan, but do you feel that the costs that you charge are justified?
Yes, we do, because we run a very small company. We don't run a huge company. We've got small funds. We've got a great team, and the performance has been way above any competitor in the market. So we justify ourselves in terms of the fees we charge, okay, and we justify that in terms of the return. And again, okay, the fee is in the return. You haven't paid for that. It's in the return, and it's been exceptional.